What's up, guys? Welcome to our first video here on YouTube. We are Jan and Arda. We're two 16 years old students from Germany with a huge passion for the financial markets. We've actually started investing 4 years ago, and ever since we've dedicated our time to learning how the economy works and how to build a good, structured portfolio. Now we want to share our journey and our insights here with you on this YouTube channel.
So we are a trading crew. We will hunt growth and value stocks, especially in the technology sector. The world is changing, and we believe that the biggest opportunities lie beyond innovation and technology. So invest in tomorrow, but start today.
And in today's video, we're looking at the major topic, the 2026 market outlook. Is the market feel real, or are we just getting started for another bull run? We've put a lot of research into this, so let's get right into the analysis.
This video isn't a financial advice. We are just sharing our own opinion, so always do your own research before picking your stocks. Let's start with the S&P 500 chart. So let me open it here. So as we can see, we're almost at the all-time highs. If you would do a price range calculation right here, it's like 4.7%. And right now we are under the 20, 50, and 100-day moving average, but we're still supported by the 200-day moving average. And we're also at the bottom of the another Watson envelope. So this could mean a trend change. The important thing is we have been up for the last 6 months, and we have been also flat for the last 3 months. And another important level is the 6,511. Right now we're at 6,630. So if the S&P falls another, let me think of it, wait a second, another 2%, then we'll be by those levels. So this levels, the support levels shouldn't break, guys. The same thing can be also said for the Nasdaq. Nasdaq has also fallen from the tops, but we're still near to the all-time highs. We're under 20, 50, and 100-day moving average, but we're still over the 200-day moving average, and we're also near the bottoms of the envelope. So the same thing for Nasdaq, pretty much. And the important resistance zone is the 23,907, which would mean fall of 2.37%. So this shouldn't happen. This zone shouldn't break. Now let's talk about the market positioning. As many of you know, we had a strong run for Nasdaq, and especially for AI specialized companies. But since the beginning of the year, the trend seems to have changed. So as we can see here, the Nasdaq is right now at minus 2.78 since the year start, and S&P also minus 2.33. But we can also see that the mid caps, small caps, and micro caps has been performing greatly since the year start. This can be caused because of the Fed interest rates cuts. I mean, the thoughts about Fed interest rates cuts, because the small companies would benefit the most from the Fed interest cuts due to the recession concerns we have, which we'll explain right after this. The same can be also said for sectors. There is also a trend shift in the sectors. As we can see, the technology is down 4.26 since year to date, and also the financial services, so as the healthcare. And we can see that the safe sectors like consumer staples, utilities, industrials, and real estate has gained a little, which could mean that the smart money is waiting for a next rally and, of course, choosing to stay in the safe places.
And one special sector that really got crashed was the software sector. If we're heading towards the Microsoft chart, we see it is the worst performing Magnificent 7 stock this year in 2026, with a loss about 16% just year to date. and it's now currently 28% from its all-time high at around 555. It was the all-time high, and another stock that actually got crashed in the service sector is ServiceNow. The PE ratio of the stock compressed to its lowest levels in 3 years, trading well below all its moving average as we see there, and it's fighting for the important $100 zone. If this would break, we can head down to 80, but if this stays, it's in good conditions. And another stock is Adobe. Yesterday they presented quarterly numbers that were actually pretty decent, but the stock got crashed again. We see it's now pretty much down like 60% from its all-time high. And yeah, despite good revenues we had yesterday, good profits they presented, they lost 8% in the after hours because the CEO is going to change, and that was pretty bad news for Adobe. But we see here the software sectors, we see in different stocks, got hit really hard by the bad news and by the last 2 months. And there's a reason why the software sector actually crashed. It's because of Anthropic. The sell-off was triggered by a new legal tool from Anthropic. Anthropic's new Claude co-work that probably you heard about is an AI agent. This is actually able to do the work for you, and of your computer you just give it a goal and it can do things on his own. So what does Anthropic change? In the past, software was a tool you had to use, like Excel or Salesforce. But Anthropic's new AI agent, like Claude, can work autonomously. That's a big change. Normally, software companies make money charging people for using their app or their software. But if this AI agent, what it actually can, work for 10 people, then company buy 90% fewer licenses. And this kills the revenue of traditional software giants, and that is the reason why we saw this massive crash in all the software sectors. And because Anthropic is so smart, other companies can now build their own custom and choose easily instead of paying for these expensive ready-made software subscriptions that the company use. So that is a big reason Anthropic is dangerous for the software sector. We saw in the past this massive crash is caused by Anthropic, and yeah, that's the point, because all of these companies just had a big short down. And one important tool we are also using is the Fear and Greed Index that underlined what happened in the stock markets right now. So if you're looking at the Fear and Greed Index, it's currently trading at 20. This is the lowest point we had in 2026. So in the best day of this year was January 15, where we stayed around 74. We were really greedy because of all the hypes, and the stocks were really performing well to this time. But now we are currently at around 20. This is the lowest point this year, as I said, which means the market is nearly, or is in extreme fear mode. We had it in. We are deep in the red zone, as we can see. And yeah, it indicates the atmosphere of panic. Investors are currently in state of high anxiety because of the Iran war and other things that are happening, other datas that are coming around, and the people are waiting now, having much fear in the market, and we have to wait. The people are waiting for the upcoming GDP and other data that maybe the market is coming back. But if you see, it's really extreme fear. But the fear zone is for investors the best zone. Always recognize that. So if you buy in the fear market, you're buying in a good market. In the extreme greed market, you should sell because they are not good points. But in the fear market, they are the best points to buy. So we are waiting that it's getting a little bit higher, and there are maybe then coming good buying opportunities.
As Jan said, the market fear is really high at the moment, and this can also be seen by the Vix Index. So we are right now sitting at 27 USD, and if we look at here, you can see it even better. So what does this mean? This means that the investors expect large market swings in the near future, and also they expect that the S&P is gonna fall. The main reason is rising geopolitical tension in the Middle East, especially Iran, as we said. The concerns about possible disruptions in the Strait of Hormuz, which is one of the world's most important oil shipping routes. And if they close the route, that would mean that a possible recession can be caused by the restriction of the Hormuz Strait. And if the oil supply is threatened, as we said, this would also create uncertainty about inflation and the global economic growth. Because of this uncertainty, people often buy hedge positions for against the S&P, and this is exactly why the VIX is getting higher. But we also think that the trend shift is near. Because we are near 30s. This could mean that this is a good zone to buy stocks, but always do your own research. As said, don't listen to us that much. Do your own research, guys.
So another important thing and topic is the consumer power. In the US, about 70% of the economy comes from people buying things. So that's clear. And the flat growth was 0% in December. That means people stopped spending more than they did the month before, which is actually bad because even during Christmas they were really cautious. So that indicates the people are not buying in the past time, and it also make it even more the recession risk. It underlined the recession risk when people stop spending money, business make less profit. So yeah, that's clear. And if this continues, it signals a recession. As I said before, the GDP and even this thing, it even indicates more that we are getting to heading forward to a recession. But like the goal is the Federal Reserve wants a soft landing, as we said several times now. So they're slowing down inflation without causing a job-killing recession. So that's important. So the data also indicates that maybe we are getting a rate cut, or we are getting a rate cut, but we're maybe getting a rate cut sooner from the Federal Reserve.
So let's look at the CPI data, the US Consumer Price Index. I think it's here right now. Yeah. So the last US CPI data came last year, and it was at 2.9%, which was also expected. This number tells us on average prices for goods and services are about 2.9% higher than from the last year. And it's also a little high than the expectations of 2%. But this wouldn't mean that right now is a Fed cut is necessary, because Fed is trying a soft landing, which means they won't rush it. They'll just look how it's going, how the inflation is going, and yeah.
So Arda talked about the CPI, and we want to talk about one really, really important thing that came out today, especially on Friday, this Friday, 13th March. We see the GDP growth rate. So the important thing is expectation. So the market expected around 2.1 to 2.5 growth for early 2026, but the real data came in February. There came some data, and they expected the plus 1.4 growth, but the data showed today actually just a plus of 0.7. That is reduced by half. That is actually not good, not good as expected. So yeah, the data were not really good, but actually tells us if this rises, it would be better. If the GDP would be high, it is strong, but interest rates would stay for longer. But as Ada said, if it's going down, and if we would had two conservative quarters of negative GDP growth, that means under 0%, below 0%, that means technically we fall into a recession. And that is really bad for the stock market, for banks, for everything. So they want to stop, or they want to try to slow down that we are not heading into a recession that fast. So they will cut interest rates. So it is a good and also a bad thing. So really good would be if the GDP stays or would come back about above 2%. It was actually the last quarter Q3 we were at 4.4%, but we fall actually really hard. So that is not a good thing, but maybe it will alert the Fed to cut interest rates faster to save the market or to save the economy from a recession.
Now I want to talk about a controversial macroeconomic scenario from Citrini research called the 2008 Global Intelligence Crisis, or the GIC. So the analysis is actually long, but I will still recommend it to read. The report explores what would happen if the artificial intelligence dramatically increases productivity while reducing the demand for the human labor. Its central concept is the intelligence displacement spiral. The idea is about that the AI becomes capable of performing knowledge work such as programming, research, customer support, and data analysis, which can also talk about as Anthropic programmed their new agentic AI models. And this could lower the labor cost, especially human labor costs, and increase corporate profits. So the companies would use AI over the human force. And according to a report, those companies would profit from the AI infrastructure rather than hiring new workers. And over time, the income from the labor declines while the share going to the capital, meaning owners of the AI systems and technology, increases. And because workers make up the majority of the consumers, lower employment and wages could lead to the weaker consumer demand, which would be crucial because this could cause a stagflation or a recession. And Citrini research also says that could result in a ghost GDP in the scenario because the productivity and output continue to rise, but much of the income goes to the capital rather than the labor, weakening the consumer economy. However, many economists argue with the scenario is unlikely to occur at this scales because, as I said, they expected a 10% unemployment rate, which would cause definitely a recession. Historically, new technologies from electricity to computers to internet initially displaced some new jobs, but eventually it displaced some jobs, but eventually created entirely new industries and employment opportunities. In addition, technology adoption usually happens gradually, and the government often intervene when employment raises significantly. So it's crucial here that the government and the companies work together that such a scenario could not and would not happen.
So let's talk about one of the most important things. What are actually expectations from the big banks? So like Morgan Stanley and Goldman Sachs are expecting around 10% gain this year from the current levels. And the most bullish or really bullish is Oppenheimer. They're expecting around 20% growth from current levels. That's actually pretty high. Oppenheimer expecting the S&P to go to 8,100. So that's the highest rating we gave. Capital Economics also is with a high rating there with 8,000. And one on the other side, we have also the more bearish or more quite skeptical ones, forecasting only moderate growth for the S&P 500 with a conservative year-end target of 7,100. So only 4% from the 6,600 we are right now. So there are some skeptical viewers like Bank of America, but overall we see from current levels the big banks, the big institutions are expecting the S&P to go higher, are expecting that we at the end of the year are more bullish, the stocks are getting higher at the end of the year, and that are the expectations from the big banks we are seeing.
We also have the midterm elections on November 3rd in the US, which will be also an important politic election. So it will be deciding who controls the Congress, and which means that the stocks can be volatile before the election. So historically, the S&P tends to fall before the elections, especially in the midterm elections year, and rise after the midterm elections with the clarity of taxes, spending, and regulations, and so on. Certain sectors like energy and healthcare can benefit depending on which party wins. But remember, long-term stocks depends more on the economics than the politics. But it should also be important that we expect the S&P to at least fall 7-8% from where we're right now, which is nearly the 6,200 levels. So this could make good buy chances, which you could use if it happens. But as I said, use these chances.
So Arda talked about it, and that was actually the point of the thing, our expectations. So we expect the market to be volatile, as Arda said, until the midterm. It could fall, but we think the end of 2026 and the beginning of 2027 are getting really great. So for the stocks and stuff, and maybe also crypto, we are getting a bull run. We are expecting a bull run. The end of 2026 will get really good, and that is the point of this video. So if you want to invest, do it. Just remember, do your own research, pick stocks, and for long term. And an important thing is, if your stock is down, the important thing is if you believe in the story. If you believe in the story of a stock, then it can be down, because long term gainers win always the most. So always recognize this.
And guys, try to buy the dip, as we say. So let's close out the video.
Yeah, thank you for watching our first video here on YouTube. It was really exciting. Thank you for that. If you want more, stay tuned for another videos. For some stock picks, we want to do it for you. Growth, some young companies, some good companies that can benefit in the next several years. So thank you for watching. Leave a like, leave a comment. Tell us what we can improve for the next videos. Thank you very much.
Thanks a lot. Peace
Stay
out.
out. Peace.